The 60/40 passive portfolio is dead. On the face of it, that's a pretty bold statement, but it isn't. It's what the numbers tell us. In this short video, we're going to demonstrate how in the post-COVID period, the traditional 60/40 equity to fixed income portfolio has failed investors. We're going to explain why it's failed and how it's likely to keep failing because the world has fundamentally changed, or to be more accurate, reverted to how it used to be. Finally, we're going to lay out a simple but more effective approach to managing portfolios going forward. We'll keep this brief and avoid going into the weeds, but can always add more detail with you one-on-one. 3 years after the onset of the Great Recession of 2008, the Vanguard 60/40 2020 target date portfolio had recovered all of its losses from that downturn. That's the purple line in this chart. Now we use the Vanguard 2020 target date fund here as our example merely because Vanguard is a ubiquitous provider of passive balance funds like the 60/40. Contrast that performance with the 3 years post-COVID. The Vanguard 60/40 2030 fund was down 14.57% from its pre-COVID high, shown once again by the purple line. And you can see that both the S&P 500, shown in blue, and the core US bond market, shown in orange, have traded down in lockstep with the 60/40 fund. Even stretching the period out from 3 years since COVID to now, about 3 years and 8 months, we see the purple line remains 13.22% down from its pre-COVID peak. So why did the 60/40 stop working for investors? The 60/40 passive portfolio is a product of its era, during which two key forces shaped its results. The first of these key forces is the bull market in bonds that finished in 2020. The second of these key forces was the negative correlation between stocks and bonds in the first 2 decades of this century. Negative correlation here just means the tendency for bond returns to go up when equity returns go down and vice versa. These two forces generated excellent results in passive 60/40 portfolios because both stocks and bonds generated very good returns, and bonds did even better when stocks fell in bear markets. In the slides ahead, we'll argue neither of those forces is likely to repeat, rendering the passive 60/40 approach inappropriate going forward. This is going to surprise a lot of advisors and their clients. Let's tackle the bond bull market first. The 10-year Treasury yield went from a peak of 15.84% in September of 1981 to a trough of 0.52% in August 2020. The collapse in that yield during this period drove a stupendous compound average return of 10% in long-term Treasury bonds. For the S&P 500, it was 12%. High inflation and high interest rates had depressed asset prices by the early 1980s to such an extent that you pretty much couldn't lose in a buy and hold portfolio consisting of these two asset classes. What made this passive buy and hold portfolio even more reliable was the second key force we're going to talk about, the fact that correlation between US equity and Treasury bond returns fell from around positive 0.5 in the mid-1990s, meaning they moved together quite a lot, to negative 0.6 after the credit crisis of 2008, meaning by then they were moving in the opposite direction by a lot. Remember that correlation ranges from +1 to -1, so these are significant numbers. That change from a positive to a negative correlation between stocks and bonds really boosted the results of the passive 60/40 portfolio. Here's another chart of stock-bond correlation, this time from the Wall Street Journal. It shows more recent data than the previous slide. Notice the stock-bond correlation is at a 2-decade high. That has been hurting the passive 60/40 portfolio because weakness in bonds has accompanied weakness in equities. But we saw on the previous chart, here it is again, that the stock-bond correlation of the last 2 decades is actually an anomaly. Going back to 1900, we can see that it is usually positive and not deeply negative. The 2010s saw the most negative stock-bond correlation in 120 years. So that begs the question, what drives that stock-bond correlation and where will it go in the future? The quantitative hedge fund AQR has done some of the best research into this that we've seen. Remember that growth and inflation are the macroeconomic drivers of stock and bond returns. AQR's work suggests that while stocks and bonds perform in the opposite directions in response to growth surprises, shown as the two sets of bars to the left here, both asset classes perform in the same direction in response to inflation changes, shown as the two sets of bars to the right. The bottom line here is that unexpected surges in inflation lead to both stocks and bonds doing poorly, which of course translates into poor performance for a passive 60-40 portfolio. 3/4 of the variation of the stock-bond correlation is explained by uncertainty around future inflation. If we add the blue part here, which is inflation risk, to the green part, which is growth and inflation correlation, we get 75%. So if inflation uncertainty drives the stock-bond correlation, which helps drive the success or failure of a passive allocation portfolio like the 60-40, what is the outlook for inflation uncertainty? Well, inflation surprises derive from the demand side and the supply side. Supply side inflation shocks are much more damaging than demand side shocks because they're so much harder for the Fed to contain via their main tool, which is interest rates. The Fed can suppress or boost demand through interest rates, but it can do nothing to lessen the impact of a supply shock to inflation. A great example of a supply shock to inflation would be the COVID production shutdowns. We think inflationary pressures have returned to more normal levels compared with the 2010s. Let me touch on a few drivers of this. The first two drivers of inflation here are from the demand side. We have the transition to green energy, which is going to place enormous pressure on the world's mineral resources. Without massive investment, the price of those minerals will continue moving higher. And then we have the federal government budget deficit, which is currently around 6% of GDP. Borrowing on this scale is overheating our economy and is inflationary. The next five I would categorize as supply-side drivers of inflation. US and to a greater extent Chinese demographics are in decline, driving up employment costs. Related to that is friendshoring, where Western companies are moving production to countries more friendly to them than China is. While that makes supply more secure, it also pushes production costs higher. And then we have the environmental, social and governance or ESG movement, spearheaded on Wall Street by BlackRock, but supported by large US banks and the federal government. The E stands for environmental, and as part of that effort, ESG is deliberately starving fossil fuel producers of capital. That should suppress production and increase prices long term, all else equal. Finally, we have the geopolitical tension between the West and an emerging axis of China, Russia and Iran. Open conflict is almost always inflationary and often unexpected. Ukraine is an example, while Taiwan is a potential future catastrophe for the prices of any product requiring a high-end semiconductor. None of these pressures existed during the period of low stock-bond correlation. Their recent emergence points to higher stock-bond correlations going forward, and thus a poor outlook for passive buy-and-hold strategies. So if a passive approach is unlikely to work because the bond bull market is over and we've returned to a normal level of stock-bond correlation, how should we manage a portfolio? We think it's simply to own what's working and avoid what isn't. That means managing fixed income as the Fed hiking or cutting cycle unfolds, while owning equities that are working and avoiding those that are not. Let me give one example of that before I wrap this up. Since the credit crisis of 2008, emerging markets have been very poor performers. They've been dead weight in a passive 60-40 portfolio. You could have allocated your emerging market funds to the S&P 500 and doubled your money instead of losing nearly a quarter of it over that 15-year period. But before the credit crisis of 2008, it was a completely different story. Emerging markets were on fire and trounced the S&P 500 by a factor of nearly 5.5 times. But your passive 60-40 portfolio would have allocated exactly the same amount of capital to emerging markets in both periods. That doesn't make a whole lot of sense. At CEG, we're focused on investing in what's working and avoiding what's not working. Isn't that what good investment plans should do? It's time to rethink the passive 60-40 approach that most advisors rely on and focus on what works so we can have the retirement that we expect. Thanks for watching. We'll see you in the next video.